Hello, this is Chuck Carnevale. This video is designed to illustrate the essence and importance of only investing in stocks at sound valuation. I specifically chose the example Digital Realty Trust, and I'm using the metric funds from operations because, as you can see, this company has had several periods where valuation has been high and low. The orange line on the graph is a multiple of 15 times each year's funds from operations. And what you can clearly see here is that there were periods of overvaluation when the price is above the orange line, periods of undervaluation, and you can see that that happened several times since 2006. However, I also want to point out that if you really look at this picture carefully, you'll notice that if I take price off the equation, you see that funds from operations growth has been very steady. This honeydew green line illustrates the dividend growth prior to being paid out, and the light green shaded area shows dividends after they've been paid out. But the point is, when you focus on fundamentals first, in this case funds from operations and dividends, you notice that price tracks operating results, earnings in a regular company, funds from operations in the case of Digital Realty. But you also notice that in the short run, which I talked about extensively in the article, prices will get out of whack when a stock gets popular, and they will get undervalued when the stock becomes unpopular. But there's this penchant for the price to always move back into alignment with fair value, and that's happened over and over again. In the article associated with this video, I was really referencing a point when the company Digital Realty had gone from a high in July of 2012, a monthly closing high of 78. The actual high was slightly over 80, and it had dropped precipitously by June 28th of the following year. Approximately 1 year later, it had fallen almost 22% over that time frame. And I bring this up because this was a time when fellow Seeking Alpha author Brad Thomas was writing an article on Digital Realty. And it was out of favor clearly. It had gone from overvaluation to fair valuation and then into undervaluation territory when Brad actually wrote his article. So we had this huge drop, but I do want you to notice that Digital Realty continued to drop from even when Brad originally wrote the article. This is where short-term price drops can be so insidious. It dropped another 20% or plus from that period of time. Now, the green dot on the graph represents a time when I personally went long Digital Realty stock, when I felt it was clearly undervalued. And I want you to notice it also fell from the time I bought it before it began rising and moving back into alignment. I consider it moderately undervalued today. The point is, though, even though there was short-term underperformance, and by clicking on the price there and then clicking this next dot, you'll see that it was initially down over 20%, and over that short period of time, that was an annualized loss of over 41%. However, if I look at it longer term from that date to where it closed on December 7th, you can see that the return is almost 12%. And I also want to point out that $11 of that came from price appreciation, but $8 of that gain came from dividends. So in the long run, earnings, and in this case, funds from operations, matter a lot more. But the real key to this presentation is to be able to go through exercises, and I encourage you to do that. Look what happens when you buy the same company with the same operating results at different valuations. For example, if I picked September of 2008 and held it to today when it was overvalued, my rate of return is still very acceptably 9.5%. However, had I waited patiently for just a short period of time and bought it 2 months later when the price to funds from operations was only 11, my rate of return almost doubles to 18.67%. So as I pointed out in the article, you can overpay for a growing business and still do reasonably well in the long run, even if you bought it in July of 2010 at 63 and a PE or a price to FFO of almost 20, and the price to FFO has fallen to 14. Because the funds from operations and the dividends both grew, you still made 6.4%. But again, buy that same stock when it was fairly valued, even though it's moderately undervalued today, and you end up making 11%. So the point of this article and the point of this presentation is to illustrate that valuation matters a lot. You end up taking less risk, and I also want to put the dividend yield on the graph. When valuations are low, are going to be consistent with times when the dividend yield is highest. So you get more yield, take less risk, and ultimately make more money in the long run. It's Chuck Carnevale. I hope this gave you some further insights into the importance of valuation. In all these examples I did, I'm buying the same company, but just at different levels of valuation. I hope you enjoyed this, and I hope it helped you understand valuation better. Thanks for listening.